All right, everybody. So as Larry said, if you can come grab your seats or basically quiet down, we're going to go ahead and get started here. So this here, everybody in the room here is a DLP investor or an existing investor, a DLP team member or an existing investor. And what I'm going to give everybody here is a little update, a little overview to what's happened in Q3 here at DLP. Hey, Jonathan, quiet everybody up back there for me. All right, so we're going to give you some update. You guys saw a lot of these updates already in the reporting that came out a couple weeks ago. I'm going to share a little bit more color. And then at about 6:30, in about 30 minutes, we will be opening up to prospective investors. And you probably noticed we put you at assigned seats. I'm going to surprise you that we're going to surround you with prospective investors and let you guys do your job of bringing us in some new investors to join us here. So without further ado, here's some recap. So Q3 was a record-breaking quarter for us in pretty much every metric. We raised $37.5 million of new investor capital, best quarter ever, over $100 million year-to-date through Q3. So I'm going to pause there and ask you guys to give yourselves a round of applause there, and thank you very much. So our goal for the year was to bring in $100 million in new capital. We're at $112 million now through October, and still counting. So it's been pretty amazing. We've deployed that money this past quarter into 70 loans and line of credits for $55 million. And we acquired 1,141 apartments in Q3. And even more importantly, we built a really strong pipeline of both loans and acquisitions, and this will likely be our biggest quarter ever for loan originations and acquisitions, which will help us to get all of our investor capital deployed into our funds, into some great properties. And most important above everything else, we exceeded our return targets once again in all of our funds, which I'll be showing here in just a moment. All right, so we hosted some great events in Q3, Asheville, North Carolina, Atlanta, Georgia, Boca Raton, Florida. A couple weeks ago, we were in Pennsylvania as well. We had an event back in early Q3 here in St. Augustine. So busy quarter in events. This past quarter, we were named one of the 5,000 fastest growing companies in America once again. That was our 7th straight year as one of the 5,000 fastest growing companies, which made us the 5th fastest growing company in America out of all companies that have made the Inc. 5000 list 7 or more times ever. So we've been very consistent ability to grow. Thank you. Also like to give a shout out to Larry. It's been a number of weeks now, but is now officially a member of our executive team as our head of investor relations. So kudos to Larry, who helps put all these events on. Many of you know, deal with Larry answering all your questions, providing you solutions and support every day. DLP Realty was named the #1 real estate team in Pennsylvania, New Jersey once again for I think the 6th straight year. We brought on Mike Kay to bolster our investor success team. Mike's around here somewhere. Where are you at, Mike? There he is. So make sure you get a chance to meet Mike tonight. Thank you. We surpassed 750 investors in Q3, and we've now surpassed 800 investors as of today. And we brought in 7 new executives to DLP in Q3. Which I'll be showing you in a moment. So here's our executive team now at DLP, and I know you probably won't be able to read these or see these that well. They're in your brochures in addition. We started the year with 12 key executives. We now have 25. And some of the leaders we brought in this past quarter, there we go. We brought in Melanie, the bottom corner there, is our president of property management. She's out right now in Arizona at one of our new acquisitions. We brought in Maggie, who's our new and first ever VP of Finance. We brought in Evan, corporate controller. We brought in Hector, director of investments. Hector's around here somewhere in the back there. We brought in, I don't know if it's still Q3, I think it was. We brought in Steven, our head of loan servicing here in the front. We brought in, essentially brought in Oren, who's my partner in Bright Homes. Officially, we partnered with Bright Homes on July 1st. And who else? We brought in Frank to head up all of our redevelopment, all of our construction and renovation of all of our apartments. So really great additions to the team. And Rich, were you in Q3? Q2, all right. So Rich, our managing director. Oh, and Dominique, who's a new managing director and senior counsel joined us in Q3. Unfortunately, she's had a 103, 104 fever all week, or otherwise you'd be meeting her here today. All right, so we also had an educational event in Asheville, North Carolina. We call these elite events, where we bring in top real estate operators, help them grow their business. And we actually have another one of these events starting tomorrow right here in St. Augustine. We have 25, 30 top real estate operators flying in from all over the country, and we'll spend the weekend helping train them, build relationships, to help them do more loans, bring us more acquisition opportunities, help them scale their businesses, and in turn help us scale ours. All right, so I'm going to skip through a couple things here. So here's some stats that are pretty interesting. So as of Q3, to end of Q3, we had $108 million in the lending fund. A year ago, we had $52 million. We have $102 million in income and growth fund. A year ago, we had $39 million. Fixed fund, just a little bigger. It's not an open fund. We're just letting existing investors add. Equity fund 2 isn't taking in capital. Pref fund went from $2 million to $20 million. And all of the funds you'll see are still hitting the same returns, or in some cases even higher returns than when we were half the size a year ago. So pretty awesome, great growth, and continuing to generate very consistent, great returns. Here are the returns we generated in Q3. It's kind of crazy how close these returns came out between our funds. So we were 12.32% in Q3 in the lending fund, 12.31% in the income and growth fund, 12.32% in the fixed fund. So our 3 lending type funds, all 12.1 or 3.1 or 3.2 returns. And then the pref fund had a 14.63% return. And the equity fund 2 had a 14.63% return. Pref fund had 11.12% return. And then we hit all of our fixed returns for all of our fixed note holders in any of our funds and strategies. So really great quarter all the way around in each and every one of our funds we're really proud of. All right, so Mike Kay, you get to meet here tonight. I'm not going to spend a lot of time. I'll let you talk to him here tonight. So that's about what we did in Q3. In Q4 here, we're expecting to continue to grow, continue to generate great returns to our investors, end the year really strong, hit all of our return targets in all of our funds. We expect to bring over $40 million in new capital in this quarter. We're going out to high net worth investors such as yourself, also bringing RIAs. We just brought in a new pension fund, so bringing some other types of investors coming and joining us as well. We expect to deploy capital this quarter into acquiring more than 1,000 apartments for over $70 million and funding over $112 million in loans and line of credits this quarter. It's going to be a busy quarter to end the year. And then a couple things that you guys will be excited about, I think. We're launching a couple new funds. So we're going to be launching a new fund called the DLP Housing Fund, which is going to be a new private REIT. So some people, when they hear the term REIT, they start thinking about what you hear in the stock market, public REITs. This is not a public REIT. This isn't something you invest in through a stock market. It's not a liquid stock. It's a private fund, just like the funds we have now. We just make a REIT tax election, which makes the fund more tax advantageous. So that fund's going to officially launch in January, but we're actually going to be putting out communication here in the next couple weeks and giving investors in the preferred return equity fund the ability to convert over to the housing fund, which will become an evergreen fund, meaning it won't have a specific end date. It'll continue to grow indefinitely, just like the lending fund, income and growth fund. It'll provide monthly distributions. It'll provide liquidity, so you don't have to lock in and stay committed for 5 to 8 years. You can redeem out every year. There's some really cool characteristics. We're going to be giving a full marketing launch of this over the next couple weeks and sharing it out with everybody, but want to give everybody in this dinner event a little heads up to the fund that's coming, and it'll become our new flagship fund that makes all of our equity investments, and it'll also be able to make loans out of it as well. So it's going to be a first of its kind hybrid fund that makes both loans and equity investments, gives the benefits of depreciation, the consistency of cash flow of our lending funds, monthly distributions, liquidity, etc. So we're really, really excited about it. It's going to be our biggest fund ever. It's going to be $1 billion fund. So it's a fund we're going to grow over the next number of years. And then we're also launching finally the DLP Positive Returns Fund. So we've been talking about this for a while. This is a regulated fund by the SEC. We just got SEC full approval on it a couple weeks ago. And this is going to be a note-only fund. So it's just going to be just like our fixed notes, except it's going to be in a specific fund that only makes note investments. And then one of the other cool things about this fund is our 1% management fee that we earn for managing the money is going to all be donated to the DLP Positive Returns Foundation, which is focused around affordable housing and creating jobs. So our goal is to raise $100 million into this fund, which means we'll donate $1 million into our foundation to really support some great causes. So we're pretty excited about that. All right, so a little bit of recap on the housing market. It's been an incredible market. If you guys might be hearing different things in the news, real estate market is absolutely on fire. Prices were up over 5% year over year in Q3, 5.4%. Homes continue to sell at record high prices, continue to sell at record high speeds, continue to have the lowest inventory ever in most markets. Real estate market's really, really strong, and considering the supply can't keep up with demand in most markets, we expect it to be pretty strong for a little while here. On the rental side, market's very strong as well. Rents went up about 4% year over year in Q3, and rents are at all-time highs in almost every market. Interest rates remain very low, expected to remain low. Home sales, we think, will be flat in Q4 year over year, but we keep saying that, and it keeps breaking records. We've been saying all year home prices wouldn't really go up, and they just keep going up. So we're going to up our expectation a little bit and say in Q4 we're going to see 2 to 3% increase in home prices. We think homes will keep selling really fast. Inventories will remain low. So here's kind of a quick visual to what's going on in the housing market. It's a very, very strong market. All right, and let me see here. I'm going to move a bit quick to open it up for questions. All right, so I'm just going to open it up here to questions to the group before we allow prospective investors to come join us. Kurt.
John, you're talking about the housing market and prices going up. We've got our children are scattered all over the country. Portland, the prices are going down. San Francisco, San Diego, or San Jose, the prices are going down. Obviously, these are high-end, complex markets. When you say that you see that kind of growth, what kind of market are you talking about?
Yeah, it's a great question. If you look at, example, the lending fund report, you'll see we do a little geography chart of where our loans are located, and none of them are in the West Coast, or virtually none of them. So we don't play a lot in those markets, but certainly markets. Miami is the closest example. Some of these higher end markets, are struggling. It's really, as a whole, the markets, the affordability sectors of those markets, prices are still going up and are really strong. It's the high end markets of the $1 million plus condos in Miami, these higher end markets where they've been saturated with new product, like Miami has been saturated with new condos. So they actually, unlike most markets in the country, they have more supply than demand. So it's a few certain markets, like the markets you just named, that in their higher end sectors are struggling. But if you go to one of those markets and try to find something under $500,000, you're not going to find prices going down. Mobile homes, yeah. So that's an interesting point in every market, even market like this. $1 million home here in St. Augustine, it's a tough market. That market never recovered. In most average price markets, the $1 million plus, $800,000 plus market never recovered. The $200,000, $300,000, $400,000 home markets in almost everywhere are incredibly hot, and there's just not enough supply. That's a great point.
Let's go to the second question.
12 months from today, do you see us in a recession?
In terms of the housing market, I think, a year from today, we're going to still have such a constraint of supply. I don't see any major decline in prices. I think we said this year, said prices will be flat to go up 1% this year. Time on market will start going up. Homes will start selling a little bit slower. Those are things we said this year. We start seeing it level out. So I think we're going to start seeing a flat market soon. I don't think we're going to see major decline in prices. One of the things I skipped over that's kind of interesting, and this is kind of Steven's world here running servicing, but the last, I think it's 11 or 12 quarters in a row, mortgage defaults have gone down. So one of the biggest trends of a recessionary environment is default going up, and default's been declining, and it's at really low rates. Mortgage defaults are like 2.4% right now, which is lower than it's been at any point, I think, since 2011 or 12. So there's a lot of strong tailwinds pushing the market right now. Now, a lot of people, of course, are thinking about what's going to happen in the election and things like that, and what could change in perception. The thing that can drive change is the financial markets tightening up and making it harder to get debt and things like that. But overall, the fundamentals of the market is really strong.
Thank you.
Great question. Rudy.
Hey Don, thank you. You mentioned the REIT that you're going to be setting up, and I would like to know what you perceive as the difference between a REIT and DST in terms of opportunities and upside, downside.
So that's probably, I'm gonna navigate from your question a little bit. So Delaware statutory trust is what he's asking about. It's not something we deal with or do here, but it's a way to invest in real estate. And there are some benefits, especially with things like 1031 exchanges and such. So it's not something we do, and it's kind of a deeper conversation. So I'd be happy to have it with you. But I think the question I'm going to deviate from your question on is, people think about a REIT and think, well, that's something that's so different than what we do now. So literally the lending fund, I skipped over this, the lending fund, which has been open for 5 or 6 years now, as of 2019 now, is a REIT. So it's simply a tax selection that we made. And the benefits of a REIT versus not being a REIT are 3 things basically. Number 1 is, instead of us giving you a K1 partnership tax return that takes us to March to produce for you, and then you have to give to your CPA and so forth, it's a lot more complicated. We give you a 1099 interest statement or a 1099 tax statement that you get at the end of January. So it simplifies your accounting and it gets you the statement sooner. So that's a big benefit. A lot of people, especially who do a lot of real estate investing, really appreciate is the 1099 statement versus having to get a K1 partnership statement. So that's one benefit. The second big benefit is there's no limitations to qualified business income deduction. So for most of us, that doesn't really matter. So what the qualified business income deduction is if you're taxed at the top federal tax rate of 37%, your income in the lending fund would be at 29%. It's a 20% deduction in your ordinary tax bracket. That's called qualified business income. But if you earn a lot of qualified business income, there's a max to how much you can earn. So I think it's about $500,000 a year. As a REIT, there's no limit to it. So you wouldn't face any limit to the maximum deduction in this qualified business income tax. And then the third other big benefit is if you're investing via retirement accounts. Some people get concerned in investing in a fund of a odd tax called UBIT, that you can face tax even on a retirement account for earning income through leverage. We've never had any of our investors ever face UBIT tax or pay any UBIT, but as a REIT, it eliminates the risk of ever having any UBIT tax. Those are a few of the main big benefits. There's really tax benefits to being a REIT. It's not anything different than that. As a lending fund investor, you're going to get a different tax statement, but nothing else is any different than what you've been receiving before. It's going to simplify your taxes, basically, is the difference.
Thank you.
So, great question. Any other questions? I know I say this every dinner, but please give me any hard questions before prospective investors get here.
Where do you see the biggest opportunity for investors in 2020?
So Anthony, who's our managing director of investments, just asked, where do I see the biggest opportunities for investment? So we still think the lending space is a really great opportunity to be right now with how strong the market is. Short-term lending, we're continuing to double down on, continuing to scale. I think it's just a tremendous place to be. It gives a lot of liquidity, reduces risk exposure. So we think that's a big opportunity. We've also been seeing some unique opportunities of being able to invest in Class A assets at Class B prices. So you'll notice that we've bought recently and are buying some Class A properties. Meaning newer, nicer properties at really Class B type prices. So one of the properties we're buying right now is a really unique situation, but we're buying a 2015 built apartment communities in Utah for $58,000 per apartment. They were just built for $140,000, $150,000 in 2015. So pretty unique play, but we're seeing a number of different opportunities to be able to get into the Class A space at below replacement costs for a variety of reasons. And whenever we see interest rates go up, which for some reasons we're hoping they go up, we were seeing this last year when rates started to go up, we're seeing guys who just built brand new apartment communities. They couldn't get their takeout financing done, so they were falling into technical default and selling at a major reduction to where they just built a property, as an example. So we saw that a good amount. So I think that we'll see those types of opportunities. You know, we're looking at some things in opportunity zones, are questions that people ask us a lot about. We have a few things in works that are interesting. But we're continuing to be focused on affordable housing. I mean, I think that the center right now of our universe is affordable housing. I think there's a major lack of that still in almost every market. That's not going to change. So finding different ways to tap into investing in affordable housing is really the center of our strategy.
Question over here. I've watched you or listened to you as you've spoken about Class B and Class C. And they were your target market largely because once you fix the properties up, those two people tend to be far more stable. And they're going to be there for a long time compared to the folks who might be in a Class A situation. What attracted you to that Class A situation that you've invested in, since it seems to be a change in your philosophy outwardly?
Yeah, great question. So yes, we still are predominantly focused on Class B housing, but the question of, you know, what does attracted to Class A in certain cases. So one of the things that we really look at, like we spent some time talking about in your question, are we going into a real estate recession, is, you know, supply and demand. So one of the properties that Anthony was just out at, Ken and I were just out a couple days ago that we're under contract to buy is a community built in 2008 and 2016 in a town near Charleston, West Virginia, and it's a market where there's zero new product being built. There's nothing in development right now, zero. So realistically, where we're at in the cycle, the fact there's nothing in development, there's probably a solid 10 years realistically, there's going to be no new product built. So even with just modest increase in population, you know, we're going to be in a really great position. There's not going to be another product where they're going to leave and go move to because it's a little bit nicer and, you know, than our product. So that's a big factor, you know, and that's what keeps us away in a lot of cases. Although, just like anybody, it's great. Who doesn't want to be in a market like a Raleigh, North Carolina? It's a great market, but, you know, there's lots of new product being built. It makes it very, very competitive where you can run into a situation of more supply than demand. But this market that we're in, there's no new supply coming. So it puts us in a really good position. And we talk, this is Class A, we're not talking $2,000 a month rents. Anthony, what are the rents in that property? About $1,000 a month. These are still very affordable apartments. These still fall into that affordability factor that, you know, 60, 70, 80% of Americans, you know, the range where they're going to be at. Most of the blue collar and even white collar workers in that market are going to be able to afford. You know, most of the new product being built today in a lot of markets, like here in Jacksonville, you know, average rent's $1,800, $1,900. Where you're starting to stretch the affordability factors. Here, you know, we're a little bit under 1,000 in a pretty strong job market with no new product coming. So there's a couple pieces to the factor. I can certainly dive a lot deeper, but in general, these Class A properties we're buying are seeing rents around $1,000. You know, $900 to $1,100 type range, still very affordable. Oh, great question. All right, I'm going to check the time. All right, so I'm going to go ahead and basically 6:30, so I'm going to stop these questions here, but if you have any other ones, save them, and we'll cover them after the dinner presentation, so feel free to dive into your salads. Prospective investors are going to come join us, and look forward to a great night. Thanks, everybody.